Hi, everyone. This is Jason Burek of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is David Urban. He is a writer for Seeking Alpha, and he runs the website True Contrarian, and he's worked in finance for over 10 years. So thank you for joining us here today, David.
Thank you for having me, Jason. It's a pleasure being on the show.
Thanks, David. Glad to finally be speaking to you actually in person instead of emails or online.
Yeah, same here. We've talked for a couple of years over email, but we've never talked person to person.
Exactly. And it's funny how technology has changed things like that. Now, getting into the markets here, you're a contrarian, David, and we were discussing before we started recording about the markets and if you think the general market is overvalued. So can you tell our listeners your opinion about the general market and if you think it's overbought or oversold?
Well, I think the general market, especially the S&P, is wildly oversold for what you're getting in terms of earnings from top companies. I mean, look at for a second with the S&P 500. It's currently trading for more than 16 times earnings, yet this quarter we're expecting earnings growth to be flat to negative. Quarter before, we came in with 4 to 5% growth. So you're really paying 16 times earnings for 4% growth. And for me personally, I've sat out this last rally because I sit down and I say to myself, there's no value within the market. How can you justify from either a value or a growth perspective buying a stock like Coca-Cola, which has a decent dividend yield, but you're paying 20 times earnings for 5% growth? By any metric that you look at this, either value or growth, Coke is overvalued and the broader market is overvalued. And when you look at GDP, I mean, for the second quarter, GDP growth is under 1.5%. I mean, we're bordering on a recession in the United States. And I know some people like the ECRI have, they've taken flack for their recession call, but it increasingly looks as if they're going to be proven correct in a year or so's time frame when we look back. And we have China, which is in a considerable slowdown, and we've got Europe, which is in a recession. I mean, despite their unwillingness to actually admit that they're in a recession, I think that we can say that the numbers coming out of Europe definitely say that they are in a recession, and the U.S. is coming very close to it. Unemployment is still high. We're not seeing GDP growth. Retail sales have stalled. It's just not an environment that's conducive for people to be on the long side right now.
Yeah, and I think people are so desperate for yield, like the fund managers, retail clients, pension funds, mutual funds are so desperate to find any kind of yield in this environment because treasuries are not really paying anything, that they're willing to overpay, like you said, for some of these assets. And I think you mentioned early in the interview, I think you said the market is oversold, but I think you really meant the market is overbought, right?
Right, overbought,
yeah.
I'm sorry.
Yeah, overbought. And one of the reasons I think the market is also overbought, besides the fact that people are so desperate for yield, is the fact that the Federal Reserve and other central banks and all these other central banks which are using U.S. dollar pegs, is that whenever the Fed creates more money on a quantitative easing or stimulus program, the total world money supply just grows massively, and that money is not going to sit in the mattress or in a bank vault or something. It's going to go looking for yield somewhere. So it's going to go into the bond market, and it's going to make bonds overvalued. It's going to go into the stock market, and it's going to make stocks overvalued. But surprisingly, David, I don't know if you'll agree with this, but one of the few places that I haven't seen yet, or at least not in the last 18 months or so, where that money has gone yet is into commodities and the natural resource sector.
No, I totally agree with you. I think actually the commodity sector is the only sector in this market that actually has any sort of growth or value profile. Juniors, small exploration firms, small producers, they've all have seen their stock prices beaten down over the last 12 to 18 months. And, they're selling for basically, bargain basement prices when you compare them against broader market stocks.
Exactly, and to use a comparison here for our listeners to show the value, you mentioned that the PE for the general market, is 16 to 20 times earnings for some of these stocks, but you can go to an ExxonMobil, a Total, some of these other large cap oil stocks, and you can buy the stocks at around 9 times earning, and they have some growth. And then you're also getting in these stocks, you're getting paid over a 5% dividend yield in a lot of these, not ExxonMobil. I think ExxonMobil's 3%, but some of these other large cap oil plays are getting over a 5% dividend yield paid to wait. So I think that's an incredible screaming buy.
Oh, I totally agree. I mean, if you look at the oil stocks, I mean, nobody around the world is stopping driving cars. I mean, yes, we're getting, better fuel efficiency, but nobody's stopping, driving. There's no massive shift to public transportation like people may have hoped for, 4 or 5 years ago. I mean, everybody's still driving everywhere. And the large cap oil stocks, I mean, like you said, there's tremendous values here. You're getting 3, 4, 5%, dividend yield to sit and wait for 9 times earnings. And even if you go down into the smaller producer levels, I mean, you're still finding stocks that have 4 to 5% dividend yields, and and small producers that are growing on top of the dividend yields. Valuations have just gotten so out of whack. But if you're a smart investor and you do your homework, this is the time when you should be active. This is the time when you should be looking for value. When I was at the 2012 PDAC conference in Toronto in March, I was in a conversation with Rick Rule of Sprott and a couple of other people, and there was a young investor there, and he said, I came here this year, but I wasn't really sure why I should be here. And I looked at him and I said, this is the exact time that you should be here, when prices are low. You don't buy when prices are high and everybody's running to the door. You do your homework now. You spend your time, you take your time, you talk to managements, you get the presentations, you review them, you talk to as many managers as you can from companies, you do your homework, and you make your purchases now when stock prices are down. You don't do it at the top. And I said, that's a mistake a lot of people make. But, there's tremendous value here. And I think for small investors, you really should be doing your homework now in the commodity sector, because once this turns around after the election and, the U.S. hits the fiscal cliff, and we know Bernanke's going to do some sort of brand new quantitative easing in order to, to dampen the effects of the fiscal cliff. We know all that's coming. And all that money is going to do is just flow right into commodities. Oil, gold, silver, rare earths, uranium, precious metals, across the board.
It's a good point. And we discussed this before we started recording, is that also in the value investor sector realm, there's a ton of value investors, except for really David Einhorn, who won't even touch resource stocks. So it's pretty ridiculous that these guys, who call themselves value investors, who are supposed to be able to run the metrics and go from asset class to asset class looking for value, and here right in front of them is all these amazing oil company opportunities. You can buy also the gold and silver royalty companies, some of these gold stocks. Newmont's even got a 3% dividend yield, which is higher than treasuries, and Newmont's got a pretty good growth profile if they can execute the mining plan, and they won't touch these stocks. So why do you think then that the conventional value investors won't buy the resource stocks?
I think that the conventional value investors have a hard time wrapping themselves around wrapping their heads around the commodity sector, because revenues can be very volatile. I mean, companies really don't have much of a handle on their revenues. I mean, they can hedge, but in this market, especially when you get down into gold and silver, you don't see anybody hedging. I mean, everybody's bullish on gold and silver prices, and nobody's hedging across the board. So what I think ends up happening is value investors, I mean, they feel comfort in going to the supermarket, seeing a box of Tide on the shelf, knowing what that box costs. They can read the price for it. They know that's a stable price. They know in their head how much it costs to make that box of Tide, and they know the margin. And when you look into the gold and silver sector, I mean, there's so many things that can happen, even in the oil sector. I mean, where we'll hear often stories of, problems in Nigeria with rebels and elsewhere in the world. It's hard for them to wrap their heads around that. And I think a second point is it kind of gets into the talent level that's working there. And this isn't meaning to denigrate the Wall Street analysts, but I think that one of the problems is if you're an analyst, if you're a banker, you're putting your brightest talent out there on the tech side. Why? Because tech is profitable for banking. The mining industry, it's not that profitable because a lot of these companies, like a Newmont or a Barrick, they don't need to come to the investment banks in order to raise capital. They can fund billion-dollar projects out of their own cash flow. And I think that you don't have quite the level of talent in the United States that you have, working on these sorts of areas. So it's harder for people to wrap their heads around, what is going on. I mean, if you went up to Canada, it's a totally different story. And this isn't to knock the Wall Street analysts or the hedge fund analysts that are doing mining or, commodities, because there are some good ones out there. It's just that it's a different perspective in the United States, which is more focused on high frequency trading and then, doing the real hard legwork that needs to be done with fundamental analysis. If you go up to Canada, on the other hand, you'll find that, the talent pool up there in terms of mining analysts is extremely deep. It's, best in the world. And, they know the ins and outs of the geology of the projects, no matter where you are. If you're in rare earths, coal, commodities, oil, gas, they know the geology. They know exactly what it's going to take to pull it out. They can figure all this stuff out. And I think that, it's a bit of a break between the two countries in terms of quality of analysts. And I think that kind of filters down to the value investors that, they're trying to wrap their heads around, gold and silver. They're trying to wrap their heads around oil, but they just can't do it because they're not trained to do that. I mean, they're not trained for that price volatility that's inherent in commodities, where you could wake up one day and see gold up by, $20 or $30, or, it could be up 5% for a day. It could be down 5% for a day. You could, I think it's harder for them to wrap their heads around it from a value perspective.
Those are very good points that I would definitely agree with, and I've literally read hundreds of analyst reports for different mining stocks, for different commodities, why this commodity is going to do well next year, the next 5 years, why this commodity won't, et cetera, et cetera. And besides the paid newsletter writers here in the United States, and there's a good amount of paid newsletter writers that have a lot of resource exposure that either used to work in Canada or actually do due diligence like you do and go up to the Canadian conferences and talk with management teams up in Canada and stuff like that. And the majority of American analysts who cover the resource sector, a lot of them they literally just copy and paste stuff out of the headlines. And I've heard of some reports for these analysts, and I've gotten my hands on copies of some oil reports that have been charged for $4,000 or $5,000, and these things I wouldn't even pay $5 for it, to be honest.
Yeah, it's tough, and I don't mean to denigrate the U.S. analysts and the guys working on this, but it's harder to wrap your head around commodity prices because you don't have any control over pricing. I mean, literally, when you think about it, I mean, outside of hedging price, what control do managements have? They really have none. So you tend to have, very conservative managers, and, it's almost like the comfort food. If you're if you're doing value work, you know what a box of Tide costs. You can go in and you can see, Colgate toothpaste. I know what that costs. I know these things.
And those companies are also going to have a better idea of what their sales are going to be, too, as well. Whereas, like with a mining company, you could have production problems more frequently. In the resource sector also, especially in mining, it's such a capital-intensive business. And the Warren Buffett philosophy of value investing tends to be that anything that's capital-intensive, they don't like.
Right.
Because there's not as much free cash flow then. Yeah. I
totally agree. It's a different management style, and it's a different mindset. that goes into working for a commodity company, and then working for, just a cut and dry, manufacturing company. They have a better idea. A manufacturing company has a very good idea of sales. They know what their product, they know, what they can sell their products for. They know what sales are going to be. They know who their end users are. They know they have a lot more comfort on the revenue side. Whereas with commodities and mining companies, it's difficult to operate in that sort of environment. And in a way, you have to be much more conservative. I mean, you never know what's going to happen on a mine. You could end up running into, different.
There's tons of problems with mining. Without going into all the different details, the water could flood the mine, like what happened with Cameco Cigar Lake, and it's been flooded for 3 years now, and they're still having problems getting it online.
Exactly. And they thought that this would be taken care of in 6 months to a year. But, the reality is once you get down there, you don't really know until you get down there, until you find out where the actual leak is or leaks, and then get down in there and plug them. It's a different sort of business.
Yeah, and it's a different sort of business. There's a lot of moving parts. It's capital intensive, like I said. There's geopolitical risk, like I said. Normally you're taking on a lot of debt or using a lot of equity financing, which the value investors don't like. But what I don't think the conventional value investors don't understand, and only David Einhorn really understands this also, is that how important gold and silver are in the macroeconomic situation, and then also that all this capital intensive stuff, everyone acts like it's only negative, but I think it's a positive in some aspects too, because it creates a barrier of entry. So, not only if you have a good management team or if you know what you're doing, are you going to be able to even raise the type of capital to get the mine built and get it into production to counterpoint that. That's
true. That's very true. There was a point I made to an analyst when I was at the 2012 PDAC. I said, this is something you should really think about, because it helps wrap your head around how difficult it is to build out a mine. I said, you're familiar with Caterpillar. And he was like, yeah. I said, you've seen the huge dump trucks they have. He was like, yeah. I said, how do you think they get a Caterpillar dump truck from the factory in the U.S. down to the mine in northern Chile that's 100 miles away from the nearest town? And he was like, I never thought of that. He's like, I never thought of
And not only that, but I mean, it's just so expensive for all the parts for the mine too, because you have what you mentioned, that those large Caterpillar trucks, those humongous earth movers, and I think the tires on those went from $1,000 or $2,000 per tire, 7 or 8 years ago, and now I think they're up to $10,000 or $15,000 per tire.
No, you're right. I mean, rubber's actually a lot of rubber plantations in Southeast Asia have been pulling back on capacity the last couple of years. There's less rubber capacity coming online. But yeah, I mean, it's something to think about. When you're thinking about what are the steps that go into building a mine. Just getting that massive truck down there is an effort into itself. And when you have to get 20 to 40 down there, it's an even bigger effort. And
running continuously for some of these mines, 24/7, 365. For some of these mines to be economic, yeah.
Exactly. And it's like I say, I'm not to denigrate the analysts, but it's more comfort food when you're dealing with a Tide or a Colgate, something that you can easily figure out. Then how difficult is it going to be to get my equipment down to a mine in Chile from the U.S. or how am I going to get cyanide, or how am I going to get what's going to happen if the balls in the crusher, something happens there. These are things that have to be thought about, and it's a difficult business to operate. And
So leading in then to another question, since you talked about this, what type of mistakes do you see then from retail investors that they make investing in the resource sector that you think are some of the common mistakes that our listeners could learn from and maybe improve upon and boost their returns?
Well, I think first, you want to make sure that you've got quality management. And if you don't have quality management, I said, that could set you back a couple of years, and that could actually, destroy your investment. Success in this business breeds success. Let's take a look at Nolan Watson, CEO, President, and Director of Sandstorm Gold and Sandstorm Metals and Energy. He's one of the founders of Silver Wheaton. How much money did he make for his investors at Silver Wheaton? Then he left and decided, I'm going to do it again. So he started up Sandstorm Gold and Sandstorm Metals and Energy. To me, it starts and ends with quality of management. You want to look for successful people. Success breeds success. There have been a number of people who have cashed out from their first round of work, and they're looking to come back and they're looking to do it again. And I think that's where investors should start. You look for quality management. You look for people that have been successful in this business, and you follow them. And you make sure that they're doing the same types of projects they were doing before, that they're not stepping too far outside of their comfort zone, and that they're on a track to repeat that success. I think that's the first thing small investors should look for, is quality of management. They look for successful people, and you follow them, because you have a better shot at hitting another 10 to 20 bagger if this person has done it before.
Yeah, I've seen, first of all, with the gold and silver companies, like comparing a gold and silver streaming company or royalty company to a mining company, it's not apples to apples. Those business models are so much more efficient. People should have the majority of the capital in those types of companies and not in the regular miners
right.
Because their business models are more efficient. They have hardly any employees. They can diversify faster. They can cash flow faster and grow faster without using nearly as much capital.
Right. But even down on the mining sector, you can use as an example, you can use a company like Santa Cruz Silver Mining, where you have Francisco Ramos, who's one of the co-founders of Great Panther Silver, left and decided that, all right, we're going to do it again. And, disappears for a year and a half, and then comes back with a silver company that's going to be going into production next year. To me, as a small investor, focus on successful people. Look for those people. If you had choice and you had a possibility of investing alongside someone like Richard Branson of Virgin, would you, given his past track record of success? I think a lot of us would. And I think, that's something that you can transfer from looking at regular brick and mortar companies to mining companies. You look for successful people. And, you follow them. You follow along with them. I think that's where, for me at least, that's where it starts and ends.
Yeah, I've seen good business operators, good managers take bad assets and still make a quality company and get it to run efficiently. And then I've also seen companies like Silver Standard where they had done a good job, finding all the silver deposits, but then they had no operating experience, and they had all these pretty good assets, and their management team just blundered it, and it's been 2 years now, and Perquita still hasn't gotten anywhere near the production guidance what they said it was going to get.
Right. That's one of the things, too, you have to look out for is just because a person is good at exploration doesn't mean that they can develop a mine. You want to make sure that they've got that track record, that they can bring it into production, and not just bringing it into production, but they realize where their deficiencies are, and they're willing to staff up accordingly. They're willing to go out there and make the right hires in order to build that mine out, because this is a business that can be ego driven. And one of the important things is to get beyond that ego and to realize that in order for me to be successful, this is an area that's a weakness for me. I'm going to go out and bring in quality people that will, contribute to this company's success.
Exactly. Now, in wrapping up the interview, I have one final question here. What types of commodities, based on supply demand, or maybe the fact that some of these mines have closed down or production's been cut off, do you still see doing well over the next 18 to 24 months despite China's hard landing? Which are your favorites for our listeners to do more research on?
Well, definitely gold and silver. I mean, that's kind of been my focus because I think that we've reached the stage that, Europe and the U.S. are doing nothing but monetizing debt right now. But even if you drill down into the oil and gas sector, I think there's tremendous values there, especially in oil. Like you mentioned earlier with some of the majors, you're getting 3, 4, 5%, just to sit in those stocks. And you look at some of the other producers, some of the smaller ones. I mean, you could easily get 4 to 5% dividend yields while you wait for the commodity prices to turn around.
We sorry to interrupt you. We actually made I made 120% in Mart Resources in the last 12 months despite the oil price going down because Mart increased production massively and they just implemented a dividend. So I think people can find if they know what they're doing, they can still make money even if the price of the commodity is going down because the company's bringing more production and increasing cash flow.
No, I agree, and I think that we'll also see. I think we'll start to see a turnaround in rare earths as well. I'm going to start stepping into that sector a little bit more. There's very few players, but I think we're going to start to see value come back into those sectors. One of the things that people mentioned to me at the Toronto Resource Investment Conference was in the year that we've seen commodity prices fall like gold, silver, rare earths, I mean, everything's kind of dropped. The bankers, the smart money, has gone back to the drawing board. They've reviewed all of the projects out there and kind of said to themselves, all right, which ones are going to be the winners? Which ones do we believe? I mean, they've been doing their homework for a year, and you're starting to see money begin to trickle into some of the juniors in each sector, from rare earths to oil to gold to silver to copper. You're starting to see smart money trickle in and take positions ahead of the next move up.
Very, very good, David. And can you tell our listeners now more about your work and some of your research reports and where else they can find your work?
Sure. You can find my work at Seeking Alpha. Just search for the author, David Urban, or you can come to the website, www.atruecontrarian.com. Right now, I'm in the process of finishing up a gold and silver report that should be out within the next couple of weeks. I'm doing the hard read edit phase right now, and I've got 9 stocks in here, 4 that you probably know of, 5 that I'm sure that you don't. In fact, 2 or 3 that I'm sure that nobody's heard about whatsoever, that nobody's heard about at all, because they're very, very early stage exploration companies, but in a very interesting and prospective districts. I'm working on that. That should be finished up in the next couple of weeks, and that's pretty much about it. You can also reach me on Twitter at DCUrban1.
Okay, and thank you for coming on a Wall Street from Main Street podcast, David, and hopefully we could have you back on again soon.
Thank you, Jason. It's been a pleasure having me, and it's been a pleasure talking with you today, and it's been a pleasure doing this podcast.